On April 12th, President Trump announced exemptions on key electronics, smartphones, laptops, semiconductors, and displays from reciprocal tariffs. Together, these decisions have temporarily eased pressure, and the markets closed sharply higher today. The Fear and Greed Index shows an improvement over last week's, as you can see. Bond yields are surging, it's a red flag for economic stability. And the dollar index is falling fast, nearing 3-year lows, shaking investor confidence in US assets. Since Friday the 14th, we've seen a clear upward move in Bitcoin. The recent tariffs announcements have created uncertainty across markets, impacting both traditional assets and cryptocurrencies. But Bitcoin has shown resilience, as investors see it as a hedge against instability and currency devaluation. Gold just hit an all-time high, now approaching $3,200 per ounce, signaling a clear fight to safety as economic fears grow. If you look at Bitcoin, altcoins, and even US equities, they are starting to crack under the pressure. Final explosion or recession incoming? Hello folks, I hope everything is going fine for you. Markets are anything but calm right now. We have seen sharp moves, surprise policy shifts, and volatility rippling across global assets. On April 12th, President Trump announced exemptions on key electronics, smartphones, laptops, semiconductors, and displays from reciprocal tariffs. This came on April 9th, just days after his 90 days pause on tariffs, which excluded China and imposed a 10% blanket tariff on other imports. For the record, the US is currently slapping a 145% tariff on Chinese imports, while China has pushed its tariff on US goods up to 125%. Things hit a boiling point, especially when knowing that 80% of iPhones are made in China, not just for Apple, but given the dependence of the tech industry on Chinese manufacturing, this latest exemption is a huge relief for Google, Nvidia, Microsoft, and pretty much the entire tech sector. And they could breathe a little easier this weekend. Together, these decisions have temporarily eased pressure, and the markets closed sharply higher today. Dow Jones ended at 40,200.71, up to 619.5 points. Standard & Poor's 500 closed at 5,363 points, gaining 90.3 points. And Nasdaq Composite finished at 16,724, rising 337 points. The Fear and Greed Index shows an improvement over last week's, as you can see. Investors are somehow reassured but still cautious and distrustful amid the ongoing volatility. Even if the tech sector welcomed the move, deeper issue remained. Bond yields are surging, it's a red flag for economic stability. And the dollar index is falling fast, nearing 3-year lows, shaking investor confidence in US assets. Meanwhile, Bitcoin has jumped sharply, but other key signals across the financial world are flashing mixed. So, in today's video, we are breaking it all down. What's fueling these moves, what the charts and heatmaps are telling us, and whether we are heading toward a breakout or a potential correction. Here we go. Okay, for now, let's see where the Bitcoin price is going on the liquidation heatmap. Since Friday the 14th, we've seen a clear upward move in Bitcoin. It climbed from around 78k to a peak near 85k, and it's now stabilizing in the 84k range. This rally was likely driven by the news of a 90-day pause on tariffs announced by President Trump. The price action has been forming that classic bullish stair-step pattern, with higher highs and higher lows, plus a few key consolidation zones along the way. When it comes to the liquidation zones, here are the critical levels that stand out, bottom to top. Support blue, 81 to 82k. This area lit up in tail blue, suggesting a lot of shorts got liquidated here. That usually means a strong buying pressure came in and built a solid base of support. Primary resistance or liquidation zone between 84k and 85k. There's a band of bright yellow and green there, signaling heavy selling pressure. This is where a lot of short positions likely piled up. And then upper resistance, 87k. A lighter colored band shows potential resistance or a liquidation wall forming at this level. If price breaks above it, we could see a chain reaction of short squeezes pushing us higher, possibly toward 89-90k. Bitcoin is now consolidating just below the 87k resistance level while holding above 83k, a healthy sign of underlying strength. The current zone on the heatmap shows low liquidations risk, which could indicate quiet accumulation before the next major move. So, based on the current heatmap structures, we can predict a break above 87k would likely trigger major short liquidations, potentially pushing Bitcoin up to 89k, 90k. If we dip below 83k, the next strong support lies around 81k, where we'd expect buyers to step back in. As long as 81k holds, the overall trend still looks bullish. The recent tariffs announcements have created uncertainty across markets, impacting both traditional assets and cryptocurrencies. But Bitcoin has shown resilience, as investors see it as a hedge against instability and currency devaluation. So, while resistance near 88k remains, Bitcoin's recovery from recent low reflects growing investor confidence, especially with easing pressure on the tech sector. Meanwhile, risk aversion is rising across markets. Gold just hit an all-time high, now approaching $3,200 per ounce, signaling a clear fight to safety as economic fears grow. Also, let us take a look at the exchange Netflow. You see the green bars for inflows, it means more Bitcoin entering exchanges, indicating potential selling pressure. Red for outflows, more Bitcoin leaving exchanges, signaling accumulation alongside the yellow line for price movements. From April 10-14, we see predominantly negative net flows, the red bars, indicating more Bitcoin leaving exchanges than entering. This often suggests reduced sell-side liquidity as Bitcoin is moved off exchanges into cold storage or other custody solutions. But keep in mind, negative net flows don't always mean accumulation, as Bitcoin could also be transferred for institutional custody or other non-speculative purposes. Still, during this period, Bitcoin steadily rose from 78k to 85k, showing that sell pressure was limited. We saw a few green bars, short bursts of selling, but they didn't reverse the overall trend. And now let's take a closer look at what the data tells us. The chart tracks total wallet balances, in pink line, which include holdings by whales but are not exclusive to them. The pink line represents the total Bitcoin balance held in wallets, excluding exchange and mining pool addresses. Key observations. White line, or Bitcoin price, shows Bitcoin's recent drop below 81k, consistent with increased selling pressure. Blue area, 30-day percent change, negative during this drop, indicating distribution, selling pressure. Pink line, total wallet balances, fluctuates alongside price movements, reflecting broader wallet behavior. Peaks in the blue area suggest accumulation phases, while dips indicate distribution. Key takeaways. Accumulation, positive blue areas tend to drive upward movements. Distribution, negative blue areas, aligns with downward pressure. The recent drop below 81k came with a clear wave of distribution. A return to positive accumulation could spark a rebound. If selling persists, Bitcoin could revisit support around 78,500k or even 74,500k. Doge is also seeing major whale action. Addresses holding between 100 million and 1 billion Doge accumulated 1.41 billion coins, over $220 million, in just 1 week. Their total holding now sits at 25.68 billion Doge, the highest level since December 2024. Let's talk macro again. There is another crucial info regarding the dollar index. You can see from the graph, the US dollar index, or DXY, is dropping below the key psychological level of 100 mark as of April 12th. Put it simply, this signals weaker confidence in the dollar. This decline aligns with the current trade tensions and the global economic uncertainty. Historically, Bitcoin has shown an inverse correlation with DXY. When the dollar weakens, investors often turn to Bitcoin as a hedge against currency devaluation and economic instability. The recent drop in DXY coincides with Bitcoin's recovery from 78k to 85k, reflecting growing demand for decentralized assets. The dollar index has now fallen to around 100, nearing its previous lows. But here's what's unusual. Ironically, while the dollar index has dropped sharply, the 10-year US bond yield is rising rapidly. And even more significantly, the 30-year bond yield is also surging, which is unusual. This kind of divergence is rare, because normally, in times of crisis, investors flock to US bonds and the dollar. That demand pushes bond yields down and the dollar up. But now, we are seeing the opposite. Dollar down, yields up. a sign of deeper loss of confidence in US markets. These shifts in the bond market are already rippling across other asset classes. If you look at Bitcoin, altcoins, and even US equities, they are starting to crack under the pressure. To sum it up, the dollar index is falling, but interest rates are rising, a combination that signals waning trust in the US economy and its currency. And this type of move has only happened 4 times in history, and each time it set off major market reactions. That's why the market is on edge right now. So, are we heading toward a final explosion or sliding into a deeper recession? The signals are mixed, the volatility is real, and macro is in the driver's seat. One thing's clear, markets are moving fast, and now more than ever, staying ahead of the curve is key. If you found this breakdown helpful, don't forget to like, subscribe, and hit the bell so you don't miss the next update. Let me know in the comments, are you bullish or bearish right now? What do you think comes first, a breakout or a meltdown? Thanks for watching, and as always, stay sharp, stay informed, and I will catch you in the next one. Bye bye.